It's time for Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank in Formation. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show. So we're going to talk about a lot of great things today. Obviously, you know, a lot of what's been going on. A lot of folks, of course, have been paying attention to the markets and that type of thing, the economy, and we've got some great news, a lot of good news coming on with COVID and things like that. You know, so that's encouraging. Businesses here in Arizona, in fact, just got announced we're going to be opening back up, you know, movie theaters and things like that, which is great. So we're starting to see a bit of normalcy coming back. And like I said, that's just a great thing. And hopefully things will just continue to get better, be on a good trajectory. And this COVID thing we can hopefully finally put behind us pretty much. Obviously, we're going to see. The thing about the markets, of course, a lot of people talk about that where, the economy is still struggling. Businesses have, really, a lot of small business in particular has really taken a hit through all the shutdowns and things like that. And the markets, though, there's some exceptions. Some large businesses, particularly in the tech arena, Apple probably being one of the most, one of the most obvious examples, have really shined and done well. And I've got this article. It's kind of funny. It's I don't say it's funny. It's interesting. We'll post this on our website at yourpersonalbank.com, of course. But it talks about market all-time highs, but it's literally boiling down to just one stock. In other words, this recovery, a lot of people said, hey, the markets seem to be like a disconnect from the economy. And actually, if you look at it a little closer, it's not so much of a disconnect. It's just that much of the, the Dow and the S&P and stuff like that has been overwhelmed by, the tech stock, the tech arenas, which a lot of those are doing really well because, the shutdowns, people are working from home more, using technology more. A great example, I've been meeting with clients through GoToMeeting and those types of Zoom and those kinds of sources for a number of years, actually. So for me personally, this hasn't been a big change because once I started speaking around the country 6 or 7 years ago on the personal bank concept, I would do a workshop, meet a bunch of folks, educate them on this concept. And of course, they're all over the country. So then after I would go home, we'd have a follow-up one-on-one meetings, which were generally done, like I said, over the computer. So it was funny. I had looked back when the shutdowns first occurred. I looked back in 2018 and 2019, and something like 85-90% of our client meetings had already been through technology. So we were kind of ahead of the curve, a little, if you will, like 2-3 years ahead of the curve. But now, of course, that's become commonplace. Everything was going that direction already. Everything was pointing to that. But, of course, COVID and the shutdowns just dramatically accelerated all that. So those companies that, provide those kinds of services and things that really what it comes down to is we're having a major shift. This COVID and the shutdowns and everything else on how business is done. There's a lot of societal shifts, business shifts that are occurring. So, again, technology in a lot of ways has really benefited from this. So when somebody says, hey, the S&P is doing really great and the markets are disconnected from the economy, it's partially true. But really, like this article says, the all-time highs are really being pushed by just a handful of stocks, and it's literally getting down to like one. A lot of the other arenas and sectors are still really suffering. I mean, travel is a perfect example of that. It's still suffering tremendously. So what's important about all this? What's the key point? Well, look, I've been talking about this really for months. We're having a shift, a dramatic change in our society, in our economy, in how business is done, all these kinds of things. And we're not, really, no one's really certain where it's all going, where it's going to end up, but there's definitely a lot of changes. And of course, again, as I stated already, the fact that, COVID seems to be, getting some good news in that arena, which is, again, awesome. It's not behind us completely. Nobody knows. We're not sure is there, how long it's going to last, what's going to happen if and when the vaccine is going to come along, hopefully soon. But again, those are uncertainties. We do have an election coming up. And pretty soon, and I think most people agree, regardless of which side of the aisle you might be on, that I think most people would agree that depending on which party is in control, or if one party is in control of, say, all three, House, Senate, and the presidency, I think we will see some difference in policy, in regulations, in taxes that can impact business and the economy and all that quite significantly. That isn't always true. I've been watching political, as many of you have, elections and stuff for many, many years. And I can say for the most part, most of the time, there are differences between the candidates and the parties, but not sharp differences that would impact our money, our economy, maybe in a dramatic way, maybe in somewhat, but not in a really significant way. I think this one's an exception to that rule. I think it's going to depend on who's in charge. And I'm not saying one is right or one is wrong, but I am definitely saying I believe it's going to be very different. And again, when it comes to your money and your investments and your future and where you're at, that can definitely impact your future and your retirement and all those types of things. So again, uncertainty is really the key, okay? And not knowing what things are going to look like going forward. Well, again, that's where Your Personal Bank, one of the areas that really shines. Again, one of our options is you can put your money in a high-paying dividend account. Basically, it's currently crediting over 6%. We have companies that have paid these out for over 25 years. This is what's interesting. A week or two ago, I had a client from Money Radio. I was showing him the charts. And by the way, this isn't really, easily obtainable or public record, but one of the financial institutions had given this to me where they were showing all the top dividend paying companies over the last 25 years and showing what they'd actually paid and all that. And he says, wow, I had no idea. I'd heard about this. I knew there were companies out there that paid these things, but I had no idea it was such a big thing. And I said, don't let them fool you. There's billions of dollars literally that's invested into these high cash value insurance contracts that pay high dividends. Again, we've got companies that have a history, 25 years plus, and currently still paying 6% or more. That's strong. But then when you put that on top of the fact that we can show you how to do that on a tax-free basis, you're talking about you've got guarantees, you're getting a good rate of return, and you can eliminate or reduce taxes. Well, for a lot of people, if you're in the 25% tax bracket, for example, a 6% tax-free investment is equivalent to an 8% taxable investment. Because, if you make 8% and you get taxed 25% on that, 6 is what's left over that for you, right? So when people say, well, 5, 6 or whatever, 6 is what we're doing these days, that's good. But my investment's making 7 or 8, and I say, well, many times you're talking about taxable versus tax-free, or the other one I hear is tax-deferred versus tax-free. See, your IRA, 401k, qualified plans are all tax-deferred. Granted, you don't pay taxes on the going in, like on a traditional IRA or 401k, for example, so you can reduce current income tax, but you're going to pay tax on the way out on those types of accounts. So tax deferred doesn't mean you're not going to get taxed. Just means you're kicking the can down the road. Now, that may or may not work. It really depends on what kind of tax brackets and income you are now versus then. What are the tax rates today versus the time frame when you pull the money out, which is an unknown, of course. And also how much money we're dealing with. How much you have now that you're deferring versus how much is going to be in the account when you take it out. In other words, if you're getting taxed on a bigger pile of money at the same tax rate, you're going to pay more taxes overall, aren't you? For example, if the tax brackets or rates increase, obviously you would end up paying more taxes going out than coming in. So that's an answer. I always ask that question to folks all the time. Can you tell me what the tax rates are going to be in a year, or even, I don't say it's a year, but 10 years from now, 20 years from now, or longer? It's impossible to know. So it's an uncertainty. And again, it's an uncertainty. One of my favorite books by David McKnight, it's called The Power of Zero. And his key point in that book is, 2 times 0 is still 0. So even if tax rates doubled, for example, 2 times 0 is still 0. So it takes that risk off the table. Contact us for more information on Your Personal Bank. I'll be happy to talk to you about it. And of course, always stay tuned. And in the next segment, we're going to talk a little bit more about this and how to reduce and eliminate risk.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. So we've been talking a lot about markets and uncertainties of the future. And this one article that I'm referring to, like I said, we'll post on our website at yourpersonalbank.com. It's from Real Money. And the title of the article is Market at All-Time Highs, but it's literally boiling down to just one stock. Is that a sign of a healthy market? See, there's been a lot of comment in the news and people discussing how the market in the last few months particularly has been disconnected from the economy. The economy, of course, has taken some big hits, seems to be on the recovery, which is great news. But, you know, because of the shutdowns and things like that, it definitely has had a major impact. And the stock market seems to be soaring along at near all-time highs. And, you know, oblivious, if you will, is maybe a good word, to what's really going on out there. If you take a closer look, it's really dominated by a few tech stocks, and it coming down pretty much almost down to like one or two stocks that are really driving this and dominating. And if you look at it closer, a lot of the stocks are nowhere near doing so well, and it's still at loss arenas. So why is that so important? Well, the markets haven't, you know, when you say, yeah, the markets are doing great and they're, you know, all-time highs and all that fun stuff, well, that's not the whole story. It's only a small piece of it. Maybe, you know, if you were in the right stocks, great, you're doing great. But if you weren't necessarily in the correct ones that have done well, not so great. What that's telling us is, you know, investors, folks that invest money into businesses or assets or any investment is really, when you're trading dollars for an investment, for an asset, it's a confidence thing, isn't it? It's a human nature confidence thing. In other words, if you're willing to part with hard-earned dollars to purchase an asset, whether that be a stock or a piece of real estate or any other asset for that matter, doesn't really matter, you're betting on or have some confidence in that asset's going to increase in value at some point in the future. I mean, that's the point of investing, right? And when uncertainty comes along, of course, that causes concern. It lowers the confidence of people willing to part with their money for that investment. I mean, that's really what it boils down to. That's basic 101 investing, okay, in assets. I don't think any reasonable person today can feel like we have a huge level, a very high level of uncertainty right now. Again, COVID, although, again, I'm going to say it seems like we're getting some good news on that front recently, and that's awesome, but it's not behind us. It's not done. There's not a vaccine yet, so we really don't know exactly what is going to happen or how it's going to impact us. It's certainly 2020, the earlier part of 2020, it certainly has had a major impact, and through the mid part of the year. The election, the uncertainty of the election, what party may be in charge afterwards, or is it going to be a split, or, you know, it's too close to tell right now. There's really no way of knowing. All these things impact our money and impacts the future, and it creates uncertainty. And that's why, like I said, one of the number one reasons why Money Radio listeners particularly contact me is about that idea or concern about reducing market risk, reducing taking some uncertainty out of their portfolio, out of their future. I talked to a listener earlier this week, in fact, and he'd been listening to me for a while, so I really appreciate that. It's kind of funny, I got to admit. Most of the folks that reach out to me, and like I said, the best way to do that is contact me at yourpersonalbank.com. I'll be happy to talk to you. You'll get to speak to me, and we can discuss how the personal bank concept can really enhance your financial future, can reduce some market risk, it can increase returns, it can reduce taxes, and again, create some diversification in a non-correlated asset, reduce your overall uncertainty on your money, okay? So we were discussing some of those types of things, and he said, yeah, I really like, you know, some of the things you've been sharing. I've been really trying to figure out what to do with my money. I know I want to reduce some market risk. He was an entrepreneur. He already, you know, he's had some major hit on income this year, hoping, you know, things are starting to come back and get a little better, but he's, you know, not certain about what's going to happen going forward and how long it's going to take. And he had some money set aside, cash reserves, all those things, all the good things that you should do. And they're important, particularly through a crisis. And like I said to him, I said, you've done really well. He didn't have any debt to speak of, which was awesome. I said, on the debt front, you've done really well. And particularly, being somebody who wasn't, he had not been a long-term entrepreneur, so he'd done really well. He had some cash reserves, which was also excellent, awesome. But as he put it, he had money sitting in some savings and various things making, like he said, I had high interest savings accounts, for example, and every month I'm getting notices that the interest rate is dropping. It's now down to below 1%. And I said, correct me if I'm wrong, but tell me this. You're wanting your money to work for you more. He goes, exactly. You nailed it on the head. I'm working hard for my money, but I also want my money that I earn, some of it at least, to start working for me. And the markets for me right now are a concern. He felt like, things being high and such, and the uncertainty going forward. He was just concerned about not wanting to put more into the market. He had some there, don't get me wrong, but he didn't want to further commit. So, and he looked around, he says, I just can't seem to find anything that pays any decent interest rate. And then so when I pointed out to him, your personal bank concept, that the high cash value insurance policies that are paying 6% plus and have done so for the last 25 years, he got pretty excited. He's like, that? And he goes, and that's really good. And I said, yeah. And I showed him how we can do it on an income tax-free basis. And he's like, well, that's excellent, because he understood it. As I said in the last segment, a 6% tax-free return is equivalent to an 8% taxable return if you're in the 25% tax bracket. If you're in a higher bracket, it's even a greater difference, even more valuable. So, bottom line is, we showed him how he can get a greater return on his money than he'd been doing, have access to the vast majority of it, which was important to him. We were able to, reduce taxes going forward, take off that tax uncertainty, at least on that bucket of money, which is also valuable. Had some guarantees. That part he really liked, because he didn't want to have to put those dollars at risk. All the things that I talk about on the show. And then the last part, when we brought in, what is the second piece of your personal bank concept? Those of you that have been listening, we've been on the show for now almost a year on Money Radio. Or if you've attended any of my workshops or looked at our website or anything you've ever done, again, yourpersonalbank.com, remember, your personal bank is 2 steps. It's setting up a high cash value policy to earn dividends, earn interest. Like I said, we have companies who have been paying 6% plus for 25 years plus, never missed, planning to continue. And you set up a bank line of credit. And the bank line of credit, of course, the collateral for the line is the cash in the policy. And we have rates in the 3s, between 3 and 3.95, depending on your situation and how much funds we're talking about. So as I pointed out to him, this gentleman, I said, if you put the money in there, you're going to get credited 6. If you leave it alone, that's what it's going to do. If you need to access some funds, by the way, in his case, we showed where he had about 85% liquidity day one. So that can be done. And I said, look, we can, if you need money for any purpose, frankly, business purpose, expenses, whatever it may be, you can access it from the bank line of credit. And in his case, the numbers were the 3.95, which was the higher end, but it still gave him a 2.15% positive arbitrage. See, here's the thing. This is the difference. This is the key. The key secret I'm going to talk about more in the next segment is how to create positive arbitrage. In other words, how to create interest, earn interest on money you spend. See, this could be money you spend for expenses. It could be money you pay debt. This could be used to invest in other assets or expand your business or any other reason for that matter. What about supplementing college education, for example, or college funding or whatever it may be? And of course, having more money for retirement. I mean, is it the goal in retirement? It isn't about how much your portfolio grows. Isn't it about how much am I going to have to spend and live on? See, it's not the growth side that's so important in retirement. It's how much income do I get? How much can I actually spend? And of course, the growth previously helps determine that, but so do the tax implications. We're going to talk about that further in that next segment, so stay tuned. And of course, as always, contact us at Your Personal Bank for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, welcome back. We are talking about one article I've been talking about today. It's from a Real Money article. We'll post this. The title is Market at All-Time Highs, but it's literally boiling down to just one stock. Is that a sign of a healthy market? And of course, the answer is pretty obvious. The answer is no. The commentary out there in society and markets and the news and all that has been for months in terms of the market is how disconnected it seems to be to the overall general economy. The economy for the past several months in many parts of the country was nearly completely shut down. We had historically bad economic numbers and results are still high unemployment, all those kinds of things going on because of COVID. And yet the markets just seem to keep climbing and climbing and going back to, after their initial crash, back in March, climb back up to all-time highs very rapidly. But when you take a closer look at it, and that's the point of this article, is the climb, the return to the all-time highs has been driven not by the overall market. It's not been broad-based at all. It's been predominantly about a handful of tech stocks to literally, it seems to be down to about one or two stocks that are really driving the markets going forward. So if you're invested in those particular stocks, great. You've seen a recovery. But if you weren't, not so great. And like I said, so it's not like the market is back. And that makes sense, actually. It makes a lot more sense. It's more logical. Because here's the thing. Is there uncertainty out there in terms of what's going to happen going forward? I mean, like I've said in the previous two segments, COVID, has had a tremendous impact on our economy in 2020. There's no denying that. Is it over? Gosh, I hope so. We're getting some positive news recently. That's great. And I hope it continues to go that route. But the reality is, no one can confidently say COVID's behind us yet, because it isn't. And so there's certainly uncertainty involved with that type of thing. Also, we have a big election coming up. Can anybody tell me today who's going to be in charge of the House, the Senate, and the White House? Or what combination is that going to be? And will that have an impact on what our economy looks like and stock, our investments and all those kinds of things? What is it going to look like? How is it going to impact that? What's the tax ramification? What's tax policy going to be going forward? What's regulations? These are all uncertainties, and I'm not saying this to scare people or anything like that. My point is, it's to be wide-eyed and open and honest about the realities of the risks and the uncertainties that are ahead of us. And one of the ways to mitigate that, as most investors know, is you diversify. Now, diversification, in my opinion, that term has kind of been bastardized. In other words, when I say diversification to most people, most investors, they'll say, "Oh yeah, I've got investments in this sector and that sector of the market." They have diversified in terms of various sectors in the markets, which is great. And if somebody's invested in the markets, they probably should do that, again, to mitigate risk. But when I say diversification, I actually mean diversifying into non-correlated assets. Now, what's a non-correlated asset? It's actually quite simple. It's a technical term that's frankly very simple. A non-correlated asset is an asset that has no correlation or nothing in common with another asset in terms of price or value. So in other words, the personal bank is a good fit for that, because if you do a fixed personal bank policy, you're getting a 6% dividend. That's what they're paying right now, 6% plus, have done so for the past 25 plus years. Okay, we've got companies that have been doing that. That has really little or nothing to do with the markets or anything like that. We get good or bad economic news, you still get your 6%. You see what I'm saying? It has no correlation in terms of this up and down, these cycles that we see. By diversifying in some of your portfolio, some of your assets into this non-correlated bucket of money, it does mitigate or reduce overall risk. Because the whole idea is, by mitigating risk, by diversifying is, hey, if one thing's going up, hopefully the other isn't going down and vice versa, right? So it kind of averages out. We have index options with the personal bank concept. I share this all the time. We have an index option where you can invest in the S&P 500 Basically, it's an index. It correlates to the S&P 500, and you will get between a 1 and 14% return on your money. Okay? If the markets go down, the S&P goes down, you get 1%. If it goes up 10, you get 10, and if it goes up 15, you get 14, okay? So it's really that kind of simple. And this is one of my frustrations I run into. I see these on articles over and over and over again. I saw one just, I think, yesterday, where somebody's like, there's a flaw. Oh yeah, here it is. There's a flaw in 401 in the they're proposing some changes on 401ks going forward. And the flaw is they're saying, well, they're going to allow indexes, annuities, and things like this as an option. And then, in the article, it talks about how, well, that's great, okay, because it can give guaranteed income for folks. There can be some tremendous options for retirement. The problem we run into all the time is then it's like the next statement they say, but then these things can be complicated. Folks, there's only one reason, well, maybe two reasons. There's a couple of reasons primarily why someone would write this or make that statement that an index annuity or an index IUL life policy is complicated. And it's funny, when you look at the contract, most of the contracts on these policies that I deal with for clients, 20 or 30 pages, which I think is ridiculous. I think it's far too long, too much legalese. But has anybody ever read a prospectus recently on a mutual fund? Those are typically 200 pages, often longer. Now, let's be real here. Let's be logical. Which is more complicated, a 20-page contract or a 200-page prospectus? You see my point. They're not that complicated. So why are people saying that? Well, one, they're not familiar with it. It's outside of their comfort zone or their normal knowledge base. And it's just human nature. It's a basic human nature for many people, when you're introduced with a new idea or a new concept, something you're not familiar with. This is human nature, by the way. The tendency for most people is kind of push back, reject, or just say that's complicated, that's too hard, or I don't want to deal with it, right? So that's a natural human reaction. That's very common. The other one is that person, like often, is a competitor. And one of the things I always like to share is, if you're sports, folks, if you're a sports fan, if you're any kind of sports fan at all, most people understand in baseball, the New York Yankees and the Boston Red Sox have not liked each other a whole lot for, well, gosh, probably over a century, right? And so asking a competitor's opinion, someone who doesn't deal with the personal bank concept, who doesn't deal with index products, who doesn't deal with annuities primarily, it's not their focus. They're more into managed funds and other things typically. Well, asking their opinion about an index product like this would be similar to asking a Boston Red Sox fan what they thought of the Yankees' chances next year. The response is probably not going to be overwhelmingly positive. Is that fair? So you see my point is if you're asking a competitor what they think, you might get some insight, don't get me wrong, and I'm not saying you shouldn't do that, but take it with a grain of salt and understand where the advice is coming from. In other words, you probably should talk to somebody who does have familiarity with this, who does have expertise with these kind of products. I've done this for 22 years, folks. It's all I've done for 22 years. I'm a specialist. I tell this to people all the time. Here's one of the things. One of the things to know about, if you're working with somebody who's an advisor or such, maybe ask them what they don't do. In other words, if somebody says they handle everything, that you're talking about a generalist. You're talking like a medical doctor in the medical profession. That would be an MD. What does an MD do when you have a specific medical issue? Well, they immediately refer you to a specialist, don't they? I tell people all the time, look, if you're looking for the next hot stock, I'm not your guy. I'm not tracking those kinds of things. I'm not paying attention to those kind of things. That's not my focus or specialty. But I'll tell you what is. You want to guarantee growth on your money? You want a consistent return, steady? You want to reduce market risk? You want to reduce taxes? Do you want to have more income for retirement? Okay. Do you have more money to expand your business or pay for college or pay the bills? How would you like to earn interest on money you spend? See, those are the kinds of things we specialize in, and that's why you should contact us at yourpersonalbank.com. Like I said, I'll be happy to talk to you about your situation. I'm not going to sell you anything. I'm going to educate you because I understand this. The better you understand your personal bank, the more likely you're going to do it. That's the purpose of this show. So stay tuned in the next segment. We'll wrap up with a few other thoughts that I think you'll find very valuable.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third. Welcome back to Your Personal Bank Show. We're going to wrap up. What we're talking about today is really this article, like I said, and the other segments. We're going to post it on yourpersonalbank.com on our website. But the title of the article is Market at All-Time Highs, but it's literally boiling down to just one stock. Is this a sign of a healthy market? And I think the answer is fairly obvious, and the answer is no, it's not a healthy market. Now, the arguments or discussions, I should say, that have been happening in society, of course, lately is, how we had the market crash in March, we had the COVID shutdowns, the economy took a real hit, and very quickly the markets recovered and got back up to all-time highs. And I think most anyone who is being honest was probably surprised by the initial drops. I know back, if you go back to yourpersonalbank.com and listen to any of the previously recorded shows, I'm on there talking about actually started talking about this in the beginning of March about, be careful, things are looking uncertain, duck and cover, so to speak, get out of the way. But even, I was one of the first to talk about it that I even saw or heard, and I got some flack, by the way, early on about how I was being an alarmist. I was trying not to be an alarmist. I was just trying to give out a warning, because actually some of the very, very first people that expressed concerns about the economy and the markets happened to be the Federal Reserve. And if you can go back and do a little research, Chairman Powell and the Federal Reserve put out some concerns about this back in late February, okay? And so I am the chairman of the board of a bank in formation. We're in the process of starting a bank. So I got wind of some of this information, by the way, that the Federal Reserve is public record, is nothing secret, about some of the concerns the Federal Reserve had about the economy and markets and various things. And when I first started sharing this, in fact, I learned about this like on the very last day of February. It was on a Friday, I remember. So the first Monday of March, I started discussing this with clients, and then on the radio. And again, first couple of weeks or so, I got a lot of pushback, a lot of flack. Oh, you're sounding alarmist and things like that. No, I was just sharing some valid and legitimate concerns that the Federal Reserve were expressing. Of course, within a couple of weeks, even the most dire concerns that they and myself had were far eclipsed. The markets, took a much bigger dive than I think most people, and faster than most people expected. It was certainly a surprise for most folks. I'm not going to say it was a surprise for me, but the dramatic and the severity definitely were surprises. Didn't expect that. But then also it's come back much quicker, much stronger than, again, most people would have expected, and I think were surprised by that. But if you dive in a little closer, like this article talks about, the return, the recovery in the markets wasn't broad-based by any stretch. In fact, it was pretty much driven by a handful of tech stocks. And to where it's literally boiling down to about one that's left that's still driving this forward. And if you were in those stocks, well, congratulations. You were in the right place at the right time, obviously. But if you weren't, not so good. What does this tell us? Again, as I've been stating in the previous statements, so even in the markets, people are willing to trade their hard-earned dollars to invest in an asset. There's a lot of concern and uncertainty about the future. COVID's not completely behind us yet. Again, we're having some good news recently. That's awesome. I hope it continues. But certainly we don't know the full ramification or how long this is going to impact us. We have an election coming up. There's significant differences in the parties and their platforms, and that could very well, depending on who's in charge, make a big difference on our money going forward and our retirements and our investments and all those kinds of things, okay, with taxes or regulatory policy or whatever that may be. So there's a lot of uncertainty, and that's where, again, investing or diversifying some of the monies into a non-correlated asset. This is something I've been talking about for quite some time. This is nothing new, but not only just diversify. I'm not talking about just diversifying into the various sectors. I'm talking about diversifying into a non-correlated asset. Basically, again, an asset that has nothing to do with the stock market. It's outside of those parameters, not impacted by those same factors. Therefore, it's not going to have the same response or same results. Now, like I said, if you go with the fixed option, we have companies been paying 6% dividends 25 years plus. Plan to continue to do so. A+ rated, tons of cash reserves, fully capable, and plan to continue to pay solid dividends going forward. And again, tremendous track record. Some of them paid for literally since before the Civil War, never missed a dividend. So these are long-term, strong, high dividend paying companies. When we combine that with the bank line of credit, where that's where you can access the funds, the cash in the policy, again, is the collateral for the loan. By the way, it works much like a HELOC or a home equity line of credit. I use this as an analogy just in terms of understanding how the bank line operates with the insurance policy, the cash in the policy. A home equity line of credit, of course, the line of credit, a bank extends a line of credit, funds that are available to you. It's usually no cost or fees to set up, and they only charge you interest when you access the funds, use the monies. They charge you interest. And the equity for the loan, the collateral for the loan is the equity in the property, right? Well, same thing here. The bank line of credit, it's called insurance bank line of credits. They call them various terms. The collateral for the loan is the cash in the policy. Why is this so important? Well, as I state, the bank line of credit current rates are in the 3s, 3 to 3.95, depending on how much money and what we're dealing with. And they're crediting 6+. So my point is simple to folks. I asked this simple question. This is the key. As I stated, I promised in the last segment I would share with you, and here it is. The secret to growing positive arbitrage and earning interest on money you spend or allocate elsewhere is this. If your money's earning 6 and then you access it through the bank line of credit and you're getting charged 3 to 3.95, what's your money doing? And the answer I get every single time people get it. You're still making 2 to 3% on your money, aren't you? Exactly. In other words, the positive arbitrage is the difference, the amount you still get to keep. Your bucket of money you invested in the personal bank policy is growing at 6. It keeps increasing, compound every year. When you access it through the bank line, you're getting charged 3 to 3.95. So, yes, you're getting charged interest on the loan. This is where a common misconception comes up. Yes, you're getting charged interest on the bank line of credit, but the interest you're getting charged is less than the interest you're earning. Therefore, your cash in the policy continues to increase at a faster rate, a bigger and bigger pile of money. The line of credit increase. If you don't pay the interest, you have the option. You can or don't have to, so you can do it without any out of pocket. If you do not pay any interest out of pocket, your bank line of credit will increase based on the interest that you're getting charged, 3 to 3.95, but it increases slower than the cash growing in the policy. And the amount available in your line increases each year based on the amount of cash in the policy. Therefore, you have an increasing amount of funds available each year. And again, this is on money you spent. This is on money you allocated elsewhere. You use those dollars. Compare that to any other investment tool out there, basically. I don't care. Stock, bond, mutual fund, CD, annuity, you pick. If you take money out of any of those accounts and you spend the dollars, what happens to your future returns on those dollars? None. Nada. Zero, right? Because you spent the money. It's gone. It's out of your control. Here, you can spend those dollars, use them for any purpose that you see fit. And what will happen? You'll still earn some interest on those, which means next year you'll have more. And the year after that, more, and so on. Doesn't that mean you'll have more money for retirement? The answer is yes. It means your money will last longer. It will go farther. And isn't that ultimately the goal for investing money for the future? So that you have more in the future that you can use, allocate, live on, spend, and then when you throw in the last piece of it, this can all be done on a tax-free basis. You've eliminated the tax consequences, which means in most cases, you'll have that much more to also live on and spend rather than paying it to tax at an uncertain rate in the future. That's what Your Personal Bank is all about. That's what makes it different. And that's why I share this idea with people. And I encourage you, contact us at yourpersonalbank.com for more information. Be happy to talk to you about how this would work for you. And as always, stay tuned to the Your Personal Bank show on 1510 AM or 105.3 FM. We're on every Tuesday at noon and every Thursday at 1. I'll look forward to seeing you next week.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.